Good afternoon. This is Sean Golding from Golding & Golding. Hope everyone's doing well today. Today we're going to focus a little bit on the issue of unreported foreign accounts, assets, and income. Unfortunately, around tax season, some taxpayers will learn for the first time that they're out of compliance. Unfortunately, this also gives ammunition to certain tax professionals to fearmonger and scare taxpayers into believing it's going to be much worse than it usually is. Let's go through the basics. The first question to consider is when someone has unreported foreign accounts, assets, or income, is it willful or is it non-willful? If it's non-willful, the taxpayer will have many different options available to them to get into compliance, and we'll get into that in a little bit. But non-willfulness is very common, and oftentimes it will result in a reduced penalty or even a penalty waiver. The next issue is whether there's unreported accounts and assets, bank accounts, life insurance policies, pension plans, things like that, or if it's income, or if it's both. When it's just income and there's no FBAR FATCA reporting, typically it may not even require one of these disclosure programs. If it involves either just the foreign assets and accounts or accounts, assets, and income, then typically some sort of amnesty will be required, and that'll vary depending on the facts. The main issues will be whether the person qualifies as non-willful, whether they qualify for reasonable cause, and if not, are they civil willful or criminal willful? Civil willful is pretty uncommon, and criminal willful is pretty rare. So most of the time, if you're just missing an account or two, please don't let any shyster get you on the phone and make you think that you're going to be going to jail or prison because you missed some foreign accounts that you might have had when you were working overseas, or they've been inactive, or you just haven't been using them for one reason or another. When it comes to foreign accounts and assets, the key issues are the penalties, and more specifically, which form was required to be filed, which form was missed, and what kind of penalty does that have. There's lots of different international reporting forms. The two main forms you'll come across are the FBAR, Foreign Bank and Financial Account Reporting, otherwise known as FinCEN Form 114, and FATCA Form 8938. FATCA is the Foreign Account Tax Compliance Act. These forms are typically used to report your basic bank accounts, investment accounts, stock accounts, life insurance policies, pension plans. Typically, you're going to have to report the maximum value. There's some additional reporting on Form 8938 than there is on FBAR. Missing the forms may result in penalties, but using one of these programs should help to alleviate, minimize, or avoid the penalties altogether. These forms are the least complicated of the international tax forms. Form 8621 gets a little more complicated. Form 8621 is for PFICs, passive foreign investment companies. And your first thought might be, well, I don't own any companies overseas. I don't have a holding company with my assets. I just have some mutual funds and some ETFs, unit trusts. But unfortunately, the definition of PFIC is thought to include items such as foreign mutual funds and foreign ETFs. The reporting from the 8621 goes from annoying to very complicated depending on whether you had any excess distributions for your dividends or if you redeemed any of your PFIC, because even though conceptually it may sound like it's just capital gain, that's not how it's calculated, and that's not how the equation works. PFIC gets hit with a much worse tax implication and is very complicated to calculate. There's lots of other forms as well. You have the 3520, which is for foreign gifts and foreign trusts, Form 3520A, which is for foreign trusts. These forms may carry a very high penalty with them. The IRS has mentioned recently that they're intending on eliminating the automatic penalties that poor taxpayers would receive simply because they failed to report a foreign gift or inheritance from a non-resident alien. Your sweet grandma passed away. She left you $500,000. You didn't report that, and now you owe the IRS $125,000. So there's lots of different forms depending on what kind of facts and what needs to be reported. Getting back to the willful or non-willfulness, okay? If you're willful, then typically the only option you have available, if you're going to do anything, right? I'm not your parent. I'm not your tax professional. There are some people who will do nothing and they'll never get caught by the IRS. Unfortunately, lots of people do nothing and then they do get caught, and then the penalties can be astronomical. If you're willful, the voluntary disclosure program is your only option. The program's gotten pretty tough over the past few years. Penalties are very high, and they want people to certify under penalty of perjury that they were intending on being willful and fraudulent. Back in the day, you didn't have to do any of that nonsense. There are non-willful taxpayers who might have picked OVDP instead of Streamline because they wanted to lock in more years of compliance, and their penalty wasn't too heavy, so it wasn't that big a deal, and they get a closing letter and peace of mind. But that's all kind of out the window right now. So the program is still fine. It's just the penalties are higher and it's less malleable than it was in years past. For taxpayers who are non-willful, there's lots of options available. There's the streamlined procedures. There's the delinquency procedures. There's delinquent FBAR and just delinquent international information return submission procedures, which just means more than just the FBAR has to be filed, and there's no unreported income similar to delinquent FBAR. There's reasonable cause, which is an alternative, but also part of the delinquency procedures. One thing I always recommend against is quiet disclosure. You will find lots of information online about it. A lot of unscrupulous tax professionals will tell you, hey, don't worry about this stuff. Just start filing going forward, or just go back and file the past stuff and don't worry about it. And sure, there are plenty of people who might do that and they will be okay, but the IRS has made it very known that if they find you and they think you did a quiet disclosure and then they can prove it, the penalties can be severe. Likewise, if you are if you're willful, then do not submit to one of the non-willful programs. Like with the streamlined procedures, you have to certify under penalty of perjury that you're non-willful. There have been some recent cases where the IRS has pursued willful civilness and criminal charges against taxpayers who they believe made fraudulent misrepresentations. Now, willfulness and non-willfulness is a gray area. You shouldn't automatically assume you're willful just because you're nervous and you're ethical and you think you made a mistake and you've gone down a rabbit hole or 2 or 10, all right? It's important that you speak with a board-certified tax law specialist, and make sure that if someone says they're board-certified, that they're certified in at least one state. There's this weird thing going on where professionals are claiming they're certified experts, board-certified tax attorneys because they have a CPA on staff, or because they self-anointed themselves as a certified expert. Even if all a firm does is practice federal law, they still have to be board-certified in at least one state. If you're looking for any assistance, you can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. We focus exclusively on offshore disclosure and compliance and expatriation. My name is Sean Golding with Golding & Golden. Thank you for your time. Have a nice rest of your day.